Those of us who have invested for a while throw around metrics like everybody should know what they mean. In this new investor series, I want to take some of these key metrics that we use to analyze dividend paying stocks so that you can understand better what's behind them and what they mean. So if you're a new investor or if you've been investing for a while and want to really dig in a little bit deeper into what some of these metrics mean and see how last week impacted my portfolio, stay tuned. Hey guys, Kevin Burgess back again with another video. Over the past few weeks, I've talked to several people, and I've really begun to appreciate the number of people who aren't familiar with dividend investing and what the terms mean. So in this new investor series, I want to take a few minutes and walk through some of the common metrics that we use to measure dividend paying stocks. And why do we use those? What they really mean. And so as you kind of walk through this journey of dividend investing, you'll become more familiar with what these metrics actually mean and how they should be used for your portfolio. Also, in addition to that, I want to give you a sense for what last week did to the portfolio. So with that being said, let's get started. Okay, before we get started, I want to make sure that you understand that just because we have these metrics that we're going to talk about that does not mean that's the whole story. So when I think of due diligence in stock investing, especially dividend stock investing, I see it in 5 categories. I look for solid financial metrics. I look for reasonable capital allocation. I look for the stock being priced at or below fair value. That kind of gives me a sense for the history of the stock. But we don't invest in the past, we invest in the future. And so therefore there are 2 other things that I look at to get me comfortable to invest in the stock, and that is that they have a profitable strategy, and then secondly that they being the management team is capable of implementing that strategy. So if they have a profitable strategy, they have the capability to implement that strategy, and they have a history of being able to do that. You put all that together, and you know what? I think that's going to be a pretty good stock to look at. So with that being said, some of the key metrics that we look for in the historical realm here, I want to walk through. And let's start with earnings per share. I know this may sound basic to some of you, but I think it's important that we understand that there are more than one earnings per share that is reported by the company in most cases. There is a GAAP earnings per share. GAAP earnings per share is the generally accepted accounting principles earnings. So those are the earnings that'll be consistent across the board for every company. They are using generally accepted accounting principles. However, most companies believe that GAAP earnings don't really tell the whole story. They don't tell the story of the business moving forward. So there are certain things that they exclude from their GAAP earnings and create something called a non-GAAP earnings, but every company calls it something different. And some of the common ones are operating earnings, and you'll actually see that in the Fast Graphs app. They call it operating earnings. Some companies call them normalized earnings. Some companies call them adjusted earnings. But just recognize that those are non-GAAP earnings, and that is what the company is wanting to measure its performance on. And I thought it'd be a good example to look at Johnson & Johnson. This is, as you see on the screen here, this is their first quarter 2022 results. They reported their sales in the red box here, but then they reported in the blue box their earnings. And you'll notice that they say diluted earnings per share are $1.93 per share, and that decreased by 16.8%. However, their adjusted, and remember adjusted earnings is one of the things that they will call it, their adjusted diluted earnings per share were $2.67, and that increased by 3.1%. Now, it's important to recognize that every company is required to provide a reconciliation between GAAP earnings and non-GAAP earnings. So let's take a look at Johnson & Johnson's GAAP to non-GAAP reconciliation. Okay, here is Johnson & Johnson's reconciliation. Now, every company is required to give you this information, but where they put it is typically different. So you'll just have to search their website for these reconciliations. But what you'll find here is in the 2022 first quarter, you'll see that they have their net earnings after tax as reported, this 5,149. That is the GAAP earnings for the first quarter of 2022. The 6,197 is the GAAP earnings of 2021. And if you recall in our previous slide, we saw that they decreased that by 16.8%. And that's where that's coming from. But then they make some adjustments and they say, hey, you know what? A better earnings number to use for us is after all of these adjustments. So the first adjustment here, and I'm only going to talk about the big ones, is intangible asset amortization expense. And it sounds like they are writing off some of their intangible assets. These could be patents, it could be intellectual property, it could even be, in some cases, goodwill that they're amortizing off. And they're saying, hey, these are non-cash amortizations that we're doing, and therefore it's not something that you should like judge us on as a management team. Then the second item would be this IP R&D. Now, anytime you see an acronym like this, it's something that the company would typically use. And so to find what that actually would mean, you would go to their latest SEC reporting. And to do that, you would go to their website, go to their investor relations page, pull up their SEC filings, and search for their last report. In this case, it's April 29th. It's the 10Q, which is the quarterly report. I usually will pull up the PDF of that. I've already done that here. And then you can just click on the search box here to search for IPR&D. And what it stands for is in process research and development. So for Johnson & Johnson, you see they have the major categories are this intangible asset amortization and the in-process research and development. The rest of these are kind of small, so I don't really concern myself with that. But if you're wanting to understand what the differences are, this is the reconciliation, and you would need to get comfortable with this reconciliation between the GAAP and non-GAAP earnings. So you'll see that most companies will have 2 earnings per share that they report, and it's important to understand the difference and what they're using to adjust their earnings, because you want to be comfortable that they're adjusting the right things to make it more meaningful. The next metric we'll talk about is the price to earnings ratio. The PE ratio is a ratio that are used by many people to determine how expensive a stock is. So the formula is the share price divided by earnings per share. It's a pretty simple formula. So as the share price moves, the PE ratio will move. Anytime earnings are reported, it impacts the PE ratio. So as the ratio goes higher, it means the stock is more expensive. And if it goes lower, it is less expensive. And it basically answers the question, how many years of earnings am I paying for this stock? So here's an example of Johnson & Johnson. The PE ratio at the time of this video was 23.76. So that means I'm paying 23.76 years of earnings for Johnson & Johnson. And so that's obviously why some people use it as a metric of how expensive a stock is. But if a PE ratio is really high, you're expecting the growth rate to be really high in that stock. So it's not wrong to buy a stock that has a PE ratio that is high, but you need to have some theory around them growing their earnings over time to recoup your investment in that stock. Just maybe a tidbit for you is there's a website called macrotrends.net, and they have the way of looking at historical PE ratios, and they're one of the few websites I've found that has this. So if you're looking for historical PE ratios, go to macrotrends.net. It's a free website. Just a tidbit for watching today's video. The next thing I'll talk about is payout ratios. A lot of times people will use these for dividend paying stocks. It basically measures the amount of net income that is paid out in dividends. So if you'll see this example here at the bottom, the net income for the company is $20,000. Dividends paid out of this fictitious company is $5,000. So 5,000 divided by 20,000 is a dividend ratio of 25%. So it's important to recognize that the lower the dividend payout ratio, the better, because of two reasons. One is it gives them the ability to raise the dividends over time, but also it gives them the ability to reinvest and grow in their business. So if you're seeing a company who is raising its dividends quickly and has the ability to reinvest in their business and continue to grow the business, that is kind of a sweet spot for me. It's also important to recognize there are two payout ratios, one related to earnings and the other related to cash flow. If you see just the term payout ratio, it refers to the earnings. And if you see a free cash flow payout ratio, it's talking about this ratio in terms of free cash flow. We'll look at some examples of this in a minute, but just recall that the free cash flow is the operating cash flow, and you'll find the operating cash flow on the cash flow statement in the financials of the company, less their capital expenditures and working capital. And basically what this means is the free cash flow is the cash that's left over after meeting the needs of the business. So that's why people use this one, this free cash flow one, and it's good to use. But you need to understand the difference between the two, because there's many times trade-offs between earnings and cash flow, and you need to understand what those are. Overall, a lot of people will use a general term of 60% payout ratio. I typically will stay away from a general term like that. I think it's important to see what industry it is and how the business is structured. So for instance, business development companies are required to pay out a certain amount of their dividends. So they're going to have dividend payout ratios that are going to be around 90%. And that's okay, because that's the way they are designed to pay out. So in most cases, I like the 60%, but it doesn't work every time. And so it's important to understand the business that they're in. Let's move on then to return on invested capital. This answers the question, how efficiently does management convert capital into profit? And it basically measures the net operating profit after tax divided by the invested capital. Now, the invested capital is the total equity plus debt plus minority interest. And some people will back out goodwill. I do not, because I think it's important to understand that the goodwill paid for acquiring businesses is part of the capital used in the business. So some will reduce the invested capital by the amount of goodwill. I do not. So my formula would be total equity plus the debt plus minority interest minus cash and cash equivalents. So obviously the higher the net operating profit after tax is, and the lower the invested capital is, that impacts this ratio in a favorable way. So you want to have a higher percentage return on invested capital. This is one of my favorite metrics, by the way, for dividend stocks. Lastly, we'll look at the interest coverage ratio. It's also pretty important. As a company incurs debt to fund its operations, you want to know how many times the earnings before interest and taxes can pay the interest expense that's incurred. The higher that number is, the better. So let's move on then to some of these examples. We're going to look at Johnson & Johnson. We're going to look at Apple, Microsoft, and Best Buy. So we're going to go to one of my favorite apps here, Simply Safe Dividend. We've pulled up Johnson & Johnson. So let's look at some of these metrics. We have a PE ratio here of Johnson & Johnson. Their historical average is 16.6, while their current is 17.2. So what does that mean? It means that they're trading right now at a little bit higher price than they have historically over the last 5 years. So now let's look at their payout ratios. Their payout ratios are in the mid-40s, so that's good. If you look at the free cash flow payout ratio, then you'll see that they are kind of inching toward the 60%. Now, if we move on then to the return on invested capital. So if you compare Johnson & Johnson's return on invested capital, 22%, to their cost of borrowing money, either using debt or equity, that's a pretty good return. And so that's why I like to look at that particular metric. The last thing is the interest coverage ratio, 193 times. I think they have no issues paying their debts. So let's move on to Apple, and we'll pull up their PE ratio, which currently is 23.8. Their historic over the last 5 years is 19.8, so they're still a little bit more expensive than they've been over the last 5 years. Let's look at their payout ratios. Very, very solid. But let's look at their return on invested capital here. It is around 64%, which is phenomenal. And their interest coverage is about 43, so they have some pretty solid metrics there. Let's move on then to Microsoft. That would be NSFT. Microsoft, their PE ratio is around 26.5, a little bit lower than they've been for the last 5 years. And let's move on then to their payout ratios. This is really cool to see. Look how they're coming down. Back in 2016, they were in the 50s. Now their payout ratio is around 24%. And their payout ratio for free cash flow is pretty consistent. So moving on then to their return on invested capital being around 34%. That's pretty incredible. And lastly, their interest coverage ratio is 38. So those are good metrics for Microsoft. Let's move on to our last stock, which is Best Buy. Best Buy has a yield of 4.41%, which is really, really high for them. Their PE ratio is 9. So basically, they are well below what their 5-year average PE ratio has been. Let's take a look at their payout ratios. They are increasing, but they're still pretty solid. Their cash flow ratio, though, looks pretty high, and we would need to dig into that to understand that further. Looking at the return on invested capital, 41%, that's phenomenal. And lastly, their interest coverage ratio is 110. So they have some pretty solid metrics in these 4 metrics that we've looked at today. So each of these companies that we've looked at today have some pretty solid metrics. But again, I want to reiterate that the metrics are only a piece of what it takes to do due diligence. We need to not only look at the history and the present, but we also need to look at the future and determine which stocks we're going to buy. So the next thing we'll talk about is how the portfolio performed the week of June 3rd. The portfolio actually went down in the market range here of about almost $10,000. That's about a 1.1% reduction. The S&P went down 1.2%. So, and we got dividends of just over $1,000. So that's good, and I put $7,300 into the account. So you can see that the balance only moved $1,400, but the dividends came in, the funding came in, and the market actually went down by nearly $10,000. So on a year-to-date basis, we have received almost $10,000 in dividends, about $450 in options trades. We have about a $10,000 gain from the market, and therefore our market change is positive 1.3%, while the S&P 500 through the end of last week was a negative 14.3%, which puts us still about a 15.6% above the S&P 500. So this is a high-level view of what happened in the market this week for the portfolio. So hopefully this has been helpful for you. If you're a new investor and you want to learn more about other metrics, leave me a message in the comments below. I'll be glad to address any metrics or any concepts that you want to learn more about as a new investor. So if you want to see more videos like this, consider subscribing to the channel. I'd love to have you along for the journey. And with that being said, I will see you on the next video.